The age-old debate is back now in this current rate environment. Do I take fixed or do I take variable? That's an interesting conversation to have because for the last 12 to 18 months, most people have been thinking of the variable rate mortgage as the worst thing on earth and run. I'd like to lock in. I don't want to go anywhere near it. All of a sudden, the conversation is back. And so for today's conversation, we're going to use some math and we're going to show you specific numbers to ask the question. If you were to renew, refinance, buy a home today, does it make more sense for you to consider possibly moving into a 5-year fixed or a 5-year variable in this different rate cycle? And yes, we're going to use a spreadsheet math. It'll be fun. But remember this, before you get into the conversation about fixed versus variable, there's a lot more variables that actually take place in this conversation that you need to think about. And we'll talk about what some of those are as well. So let's get into it. Fixed, variable, 5 years, who wins the battle? It's a big face-off. But before we do, remember one important thing, hit that subscribe button, hit that like button. If you're enjoying this information, if you're enjoying the channel, we need to spread the news. Please let more people know. Now, any questions or thoughts that you have about this chart, please make sure to hit the comment below and we'll do our best to address that. Let's get into it, shall we? The debate is back. Should I go into a fixed rate mortgage or a variable rate mortgage? And for today's conversation, we put the two head to head today to look at what would be the likely outcome if a fixed or a variable based on the forward projections and looking over the course of the next couple of years. So before we go into a fixed or a variable rate, there's a few important distinctions to think about here. First and foremost, when it comes to a 5-year fixed rate mortgage, the average Canadian consumer typically actually breaks their mortgage at around 36 months. So make sure to remember that as you're picking a mortgage. And although we haven't talked about this in detail in all of our videos, we have done previous videos to discuss the fact that when you pick a mortgage lender, when it comes to a fixed rate mortgage, you need to remember what that lender's calculation is for their interest rate differential penalty. Because, oh my goodness, if you get caught up in a CIBC or RBC 5-year fixed rate mortgage, you could be looking at paying a significant amount out to the bank if you decide to exit early, whether because of lower interest rates, lifestyle, moving, or whatever else. On the other side of the coin, if you take a 5-year variable rate mortgage, as long as you choose something that doesn't have any restrictions built into it and look out for those restrictions, typically the maximum you'll ever pay is 3 months worth of interest. So when making a decision, the rate is not the only factor. The second thing is why are people even considering a 5-year fixed or variable rate mortgage in this kind of rate environment is a big question to be asking right now. And one of the big reasons is because, well, typically over the last 10 years, the 5-year fixed has been the most popular mortgage rate product up until, well, the last 6 to 12 months where it's been a 3-year fixed and before that a 5-year variable. But that has been generally the default that the banks have been pushing and people have been taking for a long time, widely considered to be a safe mortgage product. More on that later. But for today's conversation, the reason this conversation is coming back up again is because, well, in the last few weeks, the variable rate product has been a topic of conversation. And the reason for that is that there is some positivity in the forward markets projecting as much as 75 to 125 basis point reductions in the next year, which is 2024, with the potential of up to 225 basis points in the following year. So that's over the next 2 years. Now, there's a lot of projections out there. Some are more aggressive, some are more conservative. So for today's illustration, we assumed that variable rates were to decline 175 basis points total over the term with a slight rebound, meaning 200 basis points down with 125 point up by the end of 5 years. And for a 5-year fixed, of course, this could be dated and rates can change anytime. We used an average interest rate for a well-qualified borrower over a 25-year amortization when we were qualifying, and that rate was a 6.04% rate on an insurable or uninsurable rate mortgage today. And to make sure that we were actually comparing all things equal, we used active interest rates that were available for virtually anyone to be able to access. Now, with that being said, digging into today's simulator, we're going to go and quickly summarize some of these points there for you. As we discussed, the starting mortgage balance is going to be $500,000. Our average mortgage size this year for our clients is $460,000. So this is slightly above that, but we're assuming that someone is either slightly upgrading, maybe purchasing their first home, or has a $500,000 mortgage. You can double this up over the course of a 2-year term. So again, as we discussed before, we're looking at the face-off between the 5-year fixed and the 5-year variable with a $500,000 starting balance, with our average Canadian mortgage being at approximately $460,000. For our clients, we used $500,000 as the benchmark. We used a 25-year amortization, and on the variable rate, we used a 12-month compounding or monthly compounding period because that's what most banks offer, although some do consider an alternative of a semi-annual. And with fixed rates, we typically see a semi-annual compounding period, so we've used that. So that's twice per year. We're also calculating our rate increases or changes based on months, which we'll show you in just a minute. Last but not least, we'll dig into the specifics of it. So let's have a quick little look at the fixed rate side right now, shall we? Interest rate starting at 6.04% at the start of the term. Your overall monthly payment is $3,211 with $725 to principal and $2,486 going to interest in the initial payment. And as you can see, as you continue to make your payments down over the course of the 5-year term, you can start to see by the end of the 5 years, you have $447,000 $150,000 balance, which is just over $50,000 paid on the principal mortgage and $192,000 of total payments. A little bit scary to look at it like that from that perspective, but remember, over 5 years, ideally you have appreciation, therefore increasing the value of your home, whether it's because of forced appreciation or whether it's because of the market going up in value. Now, on the variable rate side, as we start to take a little switch over here, today's starting rate, we're using a prime minus 50, and as of today in 2024, prime is at 7.2%. We're using a minus 50, which is putting us today at 6.7% prime. Now, we're looking at using the forward market projections, which is showing us, generally speaking, a very strong indication that rates will start to go down in April of 2024 at a 25-point reduction, followed by a possible July, September, and December rate reduction of 1 full percentage point. Over the following year, we've used March, June, and December of that year, another 3 quarters, followed by 2026, 2 full percentage points. Now, this is actually a relatively conservative approach because there are many other projections which are indicating higher, closer to 250 basis points and 220. So we feel like this is a relatively modest amount. One thing to note here is you'll note that the monthly payments go from $3,409 down to $2,836 over the course of that timeline, which represents a pretty significant drop and a massive increase in the amount of principal paid. As you can see in that beginning in January, February of 2024, your monthly payment is $3,439 with $647 going to principal. By the end of the rate drop cycle, you're looking at nearly $1,000 going to principal with $1,860, and your monthly payments declining by $600+. That's quite significant. And as you can see, when you start to look at the equity side of things, it does play a massive role in the amount of impact on the overall mortgage amount. So skipping forward, towards the end of the term, we don't know exactly what's going to happen, but to balance things off, we assume that in 2028, we saw a little bit of a bump back and interest rates started to increase, prime started to go back up, which put us back to 4.95 for the very end of the term. At the very end of the term, we ended up with monthly payments of $178,000, which is over $21,000 less than a 5-year fixed, principal of $56,000, interest of $121, and a net benefit on the very end of $20,000 over the 5-year fixed rate mortgage. Now, there's a few things to consider here. First and foremost, when and where the rate drops occur. If these happen later down the line, of course, we will notice a big difference. What if the initial and the first rate drop isn't until July and it only ends up being 1.75%? The net savings is only $13,000. Same thing occurs if we go ahead and push that market back, and let's say everything is the same but push back nearly a year. Same consideration, but there is still a net benefit for that consumer as we go in and update those numbers. Let's go ahead and do that. Okay, so as you can see, we dragged that down to a minus 0.25%, showing a little bit later in the game, leaving our total reductions at 175 basis points, and we're leaving our bump up right here in the end of the term. The impact is still positively beneficial for the variable rate mortgage, notwithstanding the fact that there's also a prepayment penalty advantage of going with that lender. Now, with all that being said, some of the unknowns, obviously, as we discussed, when do rates go down? How quickly do they bounce back up? And really what actually happens in your own personal situation. You could also choose to pick a 5-year fixed lender at potentially a lower interest rate than we're seeing today. Maybe rates come back down and you can benefit from a little bit of a closer gap. You can also opt to choose a 5-year fixed lender, which we call a fair penalty lender, which can help you to break that mortgage a little bit earlier. So it really, in the long run, in making any of these decisions, whether it be 1, 2, 3 year, a 4-year, 5-year fixed or variable interest rate, we don't know where interest rates are going to go. At the end of the day, you need to consider whether you prefer flexibility or certainty in your mortgage. And you just really need to be clear about who is giving you the advice, what information they're providing you, and more importantly, what type of mortgage product you're actually looking for. This is the advice that you're looking for when it comes to your mortgage, and you want to have a conversation about your renewal, your upcoming purchase. You need to get in touch with the team here at Flow so we can look at your options. I hope you've enjoyed the video, the content, and the information, and I look forward to seeing your comments below.